Right, so the next thing we want to consider now is to look at the advanced investment appraisal techniques. Now, due to the limitations that some of the basic investment appraisal techniques have, there is a need for the CFO to use the advanced investment appraisal techniques so that it will help the company to well have an understanding of the way the project will be appraised, and also to understand actually the effect of the project on the wealth of the shareholders as well as the profitability that the project will have, whether it should be undertaken or not. Now, so if you look at the internal rate of return, one of the limitations of the internal rate of return is that it is assumed that the company will reinvest the cash inflows from the project at the internal rate of return. That is why when the internal rate of return is higher than the company's cost of capital, we need to accept the project, and if it is lower, we reject the project. But the actual truth is that the company, when it has or when it receives the inflows from the project, it will not invest it at the internal rate of return. Rather, it will still invest it at the current company's cost of capital or the returns of the company. So that is a limitation for the internal rate of return, and so to solve that limitation of the internal rate of return, and that one also doesn't take into consideration the size of the project. So to solve that limitation of the internal rate of return, which assumes that a company reinvests the inflows at the internal rate of return and not at the company's cost of capital, to solve that limitation, there is a development or a new technique that we can use, and that is what we call the modified internal rate of return. So when we talk about the advanced investment appraisal, we want to look at techniques that are a build-up of what we know already, and due to the limitations that those techniques have, we want to look out for a new technique. So we'll be looking at three techniques here to be specific. We'll look at the MIRR, that is the modified internal rate of return. We'll look at the DPP, which is the discounted payback period, and we'll look at what the duration also. So these are the three advanced investment appraisal techniques that we'll be considering in relation to finding out how we can appraise projects. Now, the modified internal rate of return is very quick to calculate as compared to the internal rate of return, because you see that with a modified internal rate of return, let me just put the formula up because it's going to be a formula sorry. So the modified internal rate of return is simply going to be the square root of, okay, so the square root of totals of inflows at the cost of capital of the company divided by present value of outflows also at the cost of capital of the company minus 1. So this is going to be the formula that we're going to be using for the internal rate of modified internal rate of return. So square root of total of inflows, which will be discounted at the present value at the company's cost of capital, then present value of the outflows, still using the company's cost of capital, all minus 1, and that is going to give us the modified internal rate of return. Now, the decision rule about the modified internal rate of return is that if the modified internal rate of return is greater than the cost of capital of the company, we accept the project. If it is less than the cost of capital of the company, then we accept we reject the project. So if it is more, we accept. If it is less, we reject the project. Remember, everything we're doing here is in percentage because it's a rate, okay? So the answer will be multiplied by 100 so that we get our answer in percentages. So that is what you need to understand about a modified internal rate of return. Now, if you check your book there, I took a question and I calculated the internal rate of return there, but I'm not going to do the same thing here. I just want to go straight and focus on the modified internal rate of return. So the build-up from internal rate of return to modified internal rate of return is that with internal rate of return, we assume that the inflows will be reinvested at the internal rate of return which we have calculated. So we assume that the internal rate of return which we have just calculated for the project the inflows will be invested at that rate. But the truth of the matter is that the inflows will not be invested at that rate. The inflow will still be invested at the company's cost of capital. So it is that build-up that leads to the development of the modified internal rate of return. So let's look at how we can use the modified internal rate of return concept in order to appraise a project. And remember the decision rule: if the modified internal rate of return is greater than the company's cost of capital, we accept the project. If it is less than the company's cost of capital, we reject the project in relation to that. So Cater PLC is considering an investment in a project which requires an immediate payment of £15,000 followed by a further investment of 5,400 at the end of the first year. So the company is considering a project and immediately they are supposed to pay £15,000 and a further of £5,400 at the end of the first year. At the end of the first year, very, very important. The subsequent returns face net cash inflows expected to rise at the end of the following years. So we have from year 1 to year 5. We have the cash flows in pounds: 6,500, 7,750, 5,750, 4,750, and then 3,750. Assume cost of capital is 8%. Required: calculate the modified internal rate of return and advise Cartel PLC whether to accept the project or not. So if you check it up, we have been given the cash flows, both the outflow now 15,000, then a year after we're going to pay another 5,400. Then for the 5 years, which is the life of the project, we've been given all the inflows as well, the net cash inflows. Now, this is our formula for the modified internal rate of return: total of the inflows and the present value of the outflows minus 1. Now, these are all workings we're going to be doing. So always, I represent that this should be workings 1 and this should be workings 2. So we will do workings for the total values of the inflows discounted at the cost of capital of the company. Then we do workings 2, present value of the outflows at the cost of capital of the company. Then we come and substitute it into the formula. Then we will calculate the modified internal rate of return. So let's see how that one is done. So if we check up, you realize that we've been given the cash inflows. So we will be, remember the assumption we are using here. We are using the assumption that the inflows, the net inflows from the project will be invested at the company's cost of capital. Will be invested at the company's cost of capital. So when we do workings 1, which is total value of inflows, remember it should be at 8%, which is the company's cost of capital. So we will be reinvesting the money at the company's cost of capital. So let's go for it. See, we have T1, T2, T3, T4, and T5. The first inflows that we have is 6,500. That 6,500 will be invested at the company's cost of capital, so times 1.08. However, since it will be invested, that means that it will be exponent what? 4. Because we will invest it for the first year, so up until the 5th year, 1, 2, 3, 4. Okay, so it will be exponent 4. Remember, we are investing, so it's like you are going back to look at the investment schedule, okay, of the inflow. So when we put this money now, 5 years time, exponent 4, how much will it be? So that will give us 8,843. The second year cash flow is 7,750. That same thing, but this time around exponent 3. and that will be 9763. Third year, we're going to have 5750, 1.08. This time around, exponent 2, and that is going to be 6707. Then we will have the fourth year, which is going to be 4750. That's 1.08 exponent 1. We normally don't write it up. 5130. Then the fifth year, which is 3750, that money will not yield anything because that is the end of the project and that is the fifth year. So that money will not be invested. So we will say no investment here. So that money will still be the same money, 3750. So we are calculating modified internal rate of return, but the assumption here is that the inflows, the net inflows of the project will be reinvested at the company's cost of capital. So what we are calculating first is the total values of the inflows when they are invested at the company's cost of capital. In other words, how much money we will get if we reinvest the money at the company's cost of capital. So when we sum these up, we will get 34193. So that is our answer, 34,193 pounds. So this is how much money we will get if we reinvest, okay, the money we are getting from this project at the company's cost of capital. So that is the first thing we do in relation to calculating the modified internal rate of return. Then we move on to the second workings. So working 2, which we said should be the present value of outflows, also at the company's cost of capital. The present values of outflows also at the company's cost of capital. Now, so if you look at that well, you realize that we are told that immediately the company has to pay 15,000, but at the end of year 1, the company will pay an additional 5,400. So 5,400 divided by 0.8, and so when we do the workings and add it up, that will be 20,000 pounds. Now, you see this thing here, this thing you see here is the same as me putting year here, cash flow here, discount factor here, and present value here. So that year 0 will be the 15,000. Remember, it's an outflow, 8% will be here. This is 1.00, still 15,000 here. Then year 1, okay, I put the 5,400 here. Then I go and read on the discounting present value table 8% for one period and put it there. Then I multiply and get the answer. It's the same thing as what I have here. So that at the end of the day, when I add it up, it should give me what? The minus 20,000. So this is the present value of the cash flows that we will invest into the project. So what I've done here is the same when you do it in this way. It's the same when you do it this way. So now we have the total value of the inflows at the company's cost of capital. Then we also have the present value of the outflow at the company's cost of capital. So now we can calculate the modified internal rate of return. So our modified internal rate of return is going to be the square root of the workings 1, which was 34,193, divided by 20,000, too much zeros, minus 1. And that should give us 11.3%. So that is the modified internal rate of return. That is how we calculate the modified internal rate of return. Now, the decision rule. Should a company accept the project or reject the project? We said that if the modified internal rate of return is greater than the company's cost of capital, we accept the project. And if it is less, we reject the project. So in this case, we see that the modified internal rate of return is greater than the company's cost of capital, which is 8%. So what do? We accept the project. So this is what you need to understand about the modified internal rate of return. Now there are some advantages of using the modified internal rate of return. The first one is that it eliminates the possibility of multiple internal rate of returns, because you see, when you're calculating the internal rate of return, you realize that you do a trial and error stuff, and you can get a lot of internal rate of return depending on wherever you are standing, because somebody can use 2% and 20%, somebody can use 5% and 30%. So we will have more, we may have possible internal rate of return. But when you use the modified internal rate of return by re-discounting the cash flows at the company's cost of capital and finding out about it, then we eliminate that. That is the first advantage we stand to get. The second thing is that it does not assume that cash inflows are reinvested at the internal rate of return. Yes, this is the premise on which the module was developed, that we don't invest the cash flows at the internal rate of return. Rather, we invest it at the company's cost of capital. Third, it is consistent with the ranking with NPV. So yes, we are always taking into consideration the present value of the project or the future value of the project. So it is in line with the NPV of the project. And then the final thing is that it is a relative measure, hence easier for non-financial managers. So to some extent, people who don't really have strong financial knowledge, they will understand that if I am investing in something, the money that is coming, I will invest it at the rate that I am investing now, not at a different rate which I don't even know how it was calculated. So this is what you need to understand about the modified internal rate of return, and that is the first method or investment appraisal technique under the advanced methods. So now that we've got that out of the way, the second thing is DPP, discounted payback period. Discounted payback period. Now, you remember when we're doing payback period, we talked about how long it takes for us to pay for the project. It's the same thing here, but this time around we are taking into consideration the time value of money. You see, the payback period did not take into consideration the time value of money, which is not good, because we always assume that the money is in present term. So if we say we will receive $10,000 in 2 years time, we still assume under the payback period that we are receiving the money today. But the truth of the matter is that that 10,000 to be received in 10 years time or in 2 years time should be discounted to today's term. So to solve that limitation of not taking into consideration the time value of money under the payback period, the discounted payback period was developed so that it solves that limitation. So the approach is very simple. We're going to have the time, we're going to have the cash flow right here, we're going to have the discounting factor here, we're going to have the discounted cash flow here, and then we're going to have the cumulative discounted cash flow. That's it. So the time period or the year, the cash flow, the discounting factor at whatever rate, we have the discounted cash flow. So let me put it this way. Discounted cash flow, and then we have cumulative discounted cash flow. So this is how we present the discounted payback. Now the calculation and the technique is the same as the payback as to how we get the actual number of periods. So let's look at a question in relation to how we can calculate the discounted payback period. So example, the forecast cash flows relating to a project are, So we have a 4-year project. Cash flows, year 0 is negative 34,000 in bracket, year 1 7,600, year 2 6,500, year 3 20,000, year 4 66,000. All of these figures are in pounds. Required, calculate a discounted payback assuming a cost of capital of 10%, assuming a cost of capital of 10%. So when we are doing the discounted payback period, definitely the examiner is going to give us the cost of capital of the company, or we will be aware of the cost of capital of the company, and that will guide us as to how we are going to prepare and also calculate the payback period. So back to my schedule at 10%, so I'm going to use 10% here. And I have 5-year project, so 0, 1, 2, 5 or 4, 4-year project, 4. Year 0 is the outflow of the project, which has been given to us as 34,000. Remember, year 0 is always the same figure. So the discounted cash flow, when you multiply this by this, it still gives you this. Cumulatively, it gives you negative 34,000. Then year 1, from the question we are told that the year 1 cash flow is 7,600. When you read 10% on the present value table, it's what? 0.909. So we multiply, and that gives us the discounted cash flow, and that is going to give us 6908. 6908. Now cumulatively, okay, this is inflows, this is outflow, so this is positive, this is negative. So 34 minus 34 plus this, so it will reduce the negative to become 27 and 92. 27 and 92. That is how the cumulative discounted cash flow is done, right? So this is negative 34, but this is a positive figure. It's an inflow coming in, so it will reduce how much we are having there. Year 2, our cash flow is 16,500. Discounting factor is 0.826. So when we multiply this by this, we're going to have 13,692 again. So we have negative 27,000, but we are having an inflow of 13,692. So that will reduce our negative to somewhere around 13,463, but it's still negative. It's still negative. Year 3, our cash inflows is 20,000. Now year 3 discounting factor will be 0.756 or 751. So when we multiply up, we get 15 and 20. Now be careful here. So this is where our understanding comes in. So we have negative 13,463, but the inflow coming in is 15,020. So realize that we will hit a positive of 1557. So what then becomes the discounted payback period? So it means the discounted payback period is going to be between what? Year 2 and what? Year 3. So let's see how we go about that. So discounted payback period is going to be equal to how many years before we got to the positive? That's 2 years. So it's going to be 2 years plus how much was left before we came to the positive? That is 13,463 divided by how much cash flow came in? 15 and 20 times 1 year. Okay, times 1 year. So when we add it up and do the arithmetic, the discounted payback is going to be 2.9 years. 2.9 years. So this is how we calculate and determine the discounted payback period. As you can see, it's not a difficult aspect. It's because it incorporates the NPV concept. All right, so you get your present value or the discounted cash flows, get your cumulative cash flows, then you'll be deducting till you hit the positive. When you hit the positive, then you find out when how the payback period has been. Now, so our payback period is 2.9 years. Should we accept the project or not? Remember, I told you that when it comes to payback period, calculating it on its own is like doing ratios analysis, you cannot just say it's good or it's bad. It has to be compared with something. So if in the question we were given that the company's payback period is 3 years, then if the company's payback period is 3 years, then if the discount payback period is less than the company's payback period, then we should accept the project. If it is more, then we have to reject the project. So if the company's payback period is 3 years and we calculate and it is 2.9, because it is less, then we will accept the project. Other times, the discounted payback period is used to choose between 2 or more projects. So maybe there are 3 projects and we can use the discounted payback technique to choose which project, so that the shorter the period, the better it is for the company. So the project with the shortest time it takes to recover the cash that we put into it will be the project that we go for in relation to that. Remember, this technique does not take into consideration cash flows after the payback period. That is one of the limitations of the discounted payback period. Nonetheless, because it's incorporating the time value of money, to some extent we say that it is better than the payback period that we saw in the first aspect. So that is what you need to understand about the second method, called the discounted payback period. So we look at the modified internal rate of return, which is a build-up from the internal rate of return, where we said that the internal rate of return assumed that the inflows of the project are reinvested at the internal rate of return calculated. But the reality is that the inflows are not invested at the internal rate of return. Rather, they are invested at the company's cost of capital. That is why we developed the modified internal rate of return, to solve that deficiency that the internal rate of return has. Then we came to the payback period. We said the payback period is how long it takes for the company to recover the money that they invest in the project. But the payback period, we said one of the limitations was that it does not take into consideration the time value of money. So to solve that deficiency of the payback period, we developed the discounted payback period, which takes into consideration the time value of money by discounting the cash flows into present terms and then doing the analysis based on the present terms in relation to that. Then the last one is what we refer to as duration. Now duration is just like a payback, because normally duration, when we say duration, it simply refers to the average time taken to recover the cash flows on the investment. The average time taken to recover the cash flow from the investment. So it resembles the payback period. It looks like the discounted payback period, but this time around we use different techniques that we're going to go through. Four approaches and 2 strategies under the duration on how we calculate the average time it takes for us to recover the cash flows from a project. So when it comes to duration, it can be calculated either from 2 concepts. One, we can calculate duration by looking at the company's initial investment, or we can calculate duration looking at the present value of the projects. So 2 things must be taken into consideration. We can calculate duration taking into consideration the company's initial investment, or calculate duration looking at the present value of the project. So let's look at the first one, calculating duration taking into consideration the initial investment. So that's the first one. Now, if we are calculating duration from or using the initial investment as the benchmark, there are 4 steps or procedures that we go through, and it's very important for you to understand this step, because if you don't understand this step, then you will not be able to calculate duration. Okay, so number 1, calculate the value of each future cash flows discounted at the internal rate of return of the project. So this time around, you're going to be dealing with internal rate of return. So it will be given to you. If it is not given, then you have to calculate it, and then you will use that to do step 1, which is calculate the value of each cash flows discounted at the internal rate of return of the project. That's the first step. So after it's like calculating the present value of the cash flows at the internal rate of return. Calculating the present value of the cash flows at the internal rate of return. 2. Calculate each year's discounted cash flows as a proportion of the original capital outlay. So for each year, the present value you calculated from step 1, do a ratio for the total capital investment, and we'll look at that. 3. Take the time for the investment for each discounted cash flow and multiply it by the respective proportion. Then the 4th thing is sum up the weighted average value. So let's just make it sense and look at the question, then I'll go through the steps, then you'll get the idea. The forecast cash flow, so example, the forecast cash flow relating to a project are, so we have year, initial outflow is 34,000, year 1 is 7,600, year 2 is 16,500, year 3 is 13,000, and year 4 is 6,600. So these are the cash inflows, and then the outflow of the project is 34,000 pounds. Required. Establish the duration based upon recovering the initial investment using an internal rate of return of 11.3%. So good news, we've been given the internal rate of return because that is going to be the benchmark if we are going to calculate the duration based on recovering what? The initial investment. So how do we go about it? Remember the procedure, 4 procedures that we're going to be using. So look at the procedure 1. So I'm going to put a schedule down, and my procedure will be embedded in the schedule. So I'm just going to put procedure here. So I'm going to put a year down, and that's going to be 1, 2, 3, and 4. So what is step 1? Step 1, we said that calculate the value of each future cash flows discounted at the internal rate of return. So year 1, we are told that we will receive 7,600. So we're going to be discounting that at the company's cost of capital, which is 11.3%. So 11.3, that will be exponent 1 because it's year 1. Year 2 is 16,300, 16,500 rather. 16,500. That will also be discounted at the same rate, but this time around exponent 2. Year 3 is 13,000. That will also be discounted at the same rate, this time around exponent 3. And then year 4 is 6,600. Will be discounted at the same rate, this time around exponent 4. So that's the first procedure. We are discounting the future cash flows at the internal rate of return. So when we punch these out, respectively, we will get these answers. When we punch this out, we will get 6839. 2, we will get 13,360. 3, we will get 94,72, and then year 4 we will get 4327. So that is the step 1 that I'm talking about, that you calculate the net present value of the cash inflows at the internal rate of return. Then we said step 2, calculate each year's discounted cash flows as a proportion of the original capital outlay. Calculate each year's discounted cash flows as a proportion of the initial capital outlay. What does that mean? So procedure 2, what we do is that year 1 is 6839. We divide it by the initial outflow, which is 34,000. We take this 13,360, we divide it by 34,000, initial outlay. 94,72 divided by 34,000, then 4327. 0.27 divided by 34,000. So that is the second step. That is the second step. So what do we have? When we punch this out, we should get 0.201. We should get 0.393. We should get 0.279, and then this should give us, because of my space, I'm just bringing it a bit down, and that will be 0.127. Okay, so that is the second step. So first step, what did you say? Calculate the value of each future cash flow discounted at the internal rate of return. Boom, we did it. Second one, it says calculate each year's discounted cash flows as a proportion of the original capital outlay. That's what we did. Then procedure 3. Procedure 3. What did the procedure 3 say? Procedure 3 is saying that take the time for investment, take the time of investment for each discounted cash flow and multiply by the respective proportion. What does this mean? Simple. It simply means take this 0.201, and that is for year 1, so times 1. Take this 0.393, and that is for year 2, times 2. Then take this 0.279, and that's for year 3, so times 3. Then take this one 0.127, and that is for year 4, so you multiply it by 4. So that is what you need to understand about it, right? I just want us to be able to get the down up here. So that is what you have to understand about the third step. So first, calculate the present value of the cash flows using the internal rate of return. Second, calculate the ratio of each cash flows as a proportion of the initial capital outlay. Third, multiply the year with the proportion obtained in the second step. Then year 4. The fourth thing is you sum up the results. So when you multiply respectively, what answers will we get? So step 4, okay, we are still in step 3. So when you multiply this by this, it still gives us that same answer. Multiply this by that, that should give us 0.786. Multiply this by this, that should give us 0.836. You multiply this by this, and that should be 0.509. So these are the things that we get. Then the fourth step says sum up. Sum up. What is the meaning of sum up? Add. So finally, sum the weighted average year value. So we just add. So to get our duration, so the fourth year is where our duration comes in. So our duration will now be equal to 0.201 plus 0.786 plus 0.836 plus 0.509. So when we add these up, we are going to get an answer of 2.332 years. So this is how duration is calculated if we are recovering the initial investment. 4 steps, very, very important, you don't mix. So once you follow the step, you realize that it connects with another, and boom, you are able to get the answer in relation to that. So that is the first alternative available if we are calculating the NPV of the project. Another way we can calculate the duration is to calculate the duration in perspective of, so B, that is present value of the project. So we can calculate the duration from the perspective of the present value of the project. So how do we go about that? That is also going to go through 4 steps. So let me go through the steps right here. Then in the next video, we will look at how we calculate it. 1. Calculate the present value of each future net cash flows discounted at the chosen hurdle rate or the company's cost of capital. So this time around, you're going to be calculating present value, but not at the IRR rate, but rather at the company's cost of capital. 2. Calculate each year's discounted cash flow as a proportion of the present value of the total cash flows. So this time around also, you're not going to be doing the proportion as using the initial outlay, but rather you're going to be doing the proportion at the present value of the project. Now, I want you to get the differences very well. Third, take the time period for each discounted cash flow and multiply it by the respective proportion. And then fourth, you sum up the years. So I'll see you in the next video as we break down this, look at that same question and use this approach to solve it in relation to that.